Welcome to Breaking News to Trading Moves. Today, we are looking at a regulatory development that could change things for a few different sectors. We're talking about the recent CFTC approval for Gemini's prediction market platform.
That's right. And for you, our listener, what we want to do is pretty straightforward. We've gone through the material that's out there, and it points to some specific companies, some sectors that are expected to, do well from this, and others that might face some new competitive pressures.
Okay, so we're going to get into the mechanics behind all of that, not just the list of stocks, but the why.
Exactly. We're going to look at why the structure of this new product matters so much to these different industries.
All right, so let's set the stage. What is the event that kicked all this off? I mean, the core piece of information is that the CFTC, that's the Commodity Futures Trading Commission, has given the green light for the Gemini platform to offer crypto prediction markets.
And this is a really critical step. It's about formalizing these crypto derivatives inside the U.S. financial system.
So what does that actually look like? Structurally, I mean, what do they get approval for exactly?
Yeah, so when you dig into the specifics, the entity is Gemini Space Station, which the documents call GEMI. They've secured a CFTC designated contract market license.
Okay, a designated contract market license. That sounds pretty official.
It's the gold standard in the derivatives world. I mean, this is what the big players like the CME Group operate under. So for a crypto-based prediction market to get this license, it's a landmark event. It puts these products squarely inside the regulated centralized clearing structure of U.S. finance.
So that puts Gemini in the same league, at least from a regulatory perspective, as the established giants. What does that license actually let their affiliate, Gemini Titan, offer to people?
It allows them to offer regulated prediction markets, but specifically within the United States. And the type of product they're offering is really key here. They're focused on simple, binary, yes or no event contract.
Okay, simple, not complex derivatives.
Yeah, exactly. They're not trying to introduce some, multi-legged options strategy or anything exotic. They are going for clarity and simplicity.
Binary, so the result is either it happens or it doesn't, 0 or 1. The outcome is absolute, which I guess removes the complexity of like partial payout or something like that.
That's it. And the material gives some really clear examples of the kinds of contracts we're talking about. So traders could engage in products that predict, say, a specific Bitcoin price level by a certain date.
Like, will Bitcoin get above $70,000 by the end of the quarter? A simple yes or no.
Exactly that. Or it could be about predicting regulatory outcomes, something like, will the SEC approve an Ethereum ETF before this specific deadline? Again, just yes or no. The core difference between this and, the way people have speculated on crypto before is that this whole operation, it has to function inside that CFTC supervised framework.
And that oversight is the game changer.
It is. It enforces rules on things like capital requirements, market surveillance, and this is a big one, position limits. That makes it much more palatable for the institutional players, the ones who've been waiting for some regulatory certainty before they jump into a market like this.
Right. That CFTC stamp of approval just elevates these contracts way above the, let's call it the gray market speculation or the offshore platforms. So this regulatory approval, it's like a catalyst, isn't it? It affects a bunch of different sectors all at once.
It does, because the market just perceives regulated activity differently. It's a fundamental thing. I mean, unregulated activity comes with counterparty risk, custodial risk, and you've always got the threat of a regulatory crackdown hanging over your head.
But a CFTC designated contract market license, that signals government sanction, integrity.
Precisely. And that change in perception has real, tangible effects on the valuation and the future path of companies that are operating in or even just near the crypto world. A lot of institutional funds, endowments, sovereign wealth funds, their own internal rules, their compliance mandates, require them to use instruments traded on a DCM.
So this just opened up a door for them that was completely shut before.
A whole new avenue for risk management and speculation for players who were, just like you said, locked out.
Okay, let's get into the companies then. Let's start with the anticipated gainers. We've got 3 categories here, and the common thread seems to be this idea of validation, regulatory validation for crypto products. Let's start with category 1, regulated crypto platforms and exchanges.
Yeah, and the logic here is pretty compelling. The CFTC approval, it's like a regulatory proof of concept. It shows that the U.S. regulatory machine, which has been, let's face it, notoriously cautious, it's getting more receptive to crypto products.
But with a big condition.
A very big condition, provided they play by the rules. They have to adhere to strict financial oversight and market integrity standards. So this isn't just a win for Gemini. It sends a signal about broader acceptance for compliant, structured, digital asset products.
And that acceptance just gives a lift to the whole regulated ecosystem, right?
Huh.
It suggests the path for other compliant financial products built around crypto is getting wider. Makes the whole sector seem a little safer, a little more durable to traditional investors.
It does. And that regulatory comfort is expected to boost trading volumes across the sector. But even more than that, it creates opportunities for other regulated platforms to expand their products. When one well-funded player gets a DCM license for a new product like this, they've basically created a blueprint.
A blueprint for others to follow.
Right. It de-risks the whole regulatory process for their competitors and shows feasibility to the big institutional capital providers, the ones who might use one regulated place for custody and another for derivatives.
Okay, so let's name some names in this first category. First up is Coinbase Global, ticker symbol COIN.
Right, COIN. As the major publicly traded and regulated U.S. exchange, they are in a unique spot to capture the secondary benefits of this trend. When the CFTC formalizes a new derivative class like this, it just expands the total addressable market for all compliant crypto products.
But how does that new capital flow directly to COIN? I mean, the contracts are launching on Gemini's platform, not theirs.
It's not always direct, it's multifaceted. First, institutions need regulated custody for their underlying assets, right? Even if they're trading derivatives somewhere else. COIN is a leader in custody.
Okay, that makes sense.
Second, just the general increase in comfort level from this DCM approval will help sentiment and liquidity in the spot market, which is COIN's main source of trading revenue. And finally, COIN is perfectly positioned to follow this blueprint we just talked about.
To launch their own version.
Exactly. If these prediction markets take off and prove to be popular under this regulated structure, COIN has the resources. They have the existing exchange infrastructure. They could launch complementary or even directly competitive products and leverage their massive user base to grab market share pretty quickly.
So it's about the rising tide of volume, but also about proving that their whole strategy, their multi-year effort to seek regulatory compliance, was the right one.
Without a doubt. This move really reinforces the idea that the future of U.S. crypto trading is with the compliant players. And that validation goes beyond just the exchanges, which leads us to the second company mentioned here, MicroStrategy, ticker MSTR.
Wait, this one's a bit different. They're a software company that just happens to hold a lot of Bitcoin on its balance sheet. They don't facilitate trading, so why do they gain from a derivatives approval?
Yeah, this is where the analysis gets a little more nuanced. It's because of their function as a primary equity proxy for Bitcoin.
A proxy.
Yeah, think about it. A lot of institutional mandates, especially for big traditional pension funds or asset managers, they have strict rules. Rules that either prohibit or heavily restrict them from investing directly in Bitcoin or other unregulated spot crypto products. But they can buy stock in a public company like MSTR.
So MSTR becomes this sort of legal and compliant workaround, a way to get exposure to Bitcoin's price action, but it's all wrapped up in a corporate equity structure.
That's it, exactly. The thinking is that MSTR gains because this broader institutional interest in regulated crypto products, which is spurred on by things like the Gemini approval and just a general improvement in market sentiment, it all accrues to these established crypto-adjacent companies.
So when the regulatory climate for derivatives looks safer?
The fund managers who couldn't touch the actual token before suddenly feel more comfortable allocating capital to the equity proxy. This regulatory endorsement acts as a psychological catalyst. It can improve MSTR's liquidity and often supports the premium that its stock trades at relative to the actual Bitcoin it holds.
So it's really less about their software business and more about its utility. Its utility as a preferred, legally permissible way for certain types of conservative capital to get exposure. And that capital is now feeling less risk because of what the CFTC did.
You've got it. If the market for regulated crypto derivatives is growing and gaining legitimacy, the underlying asset is seen as more durable, and the main equity vehicle for that asset benefits from that improved perception of stability and future viability.
Okay, that covers the direct crypto beneficiaries. Let's pivot now to the second category, derivatives and market infrastructure. This is like the plumbing of the financial system, right? How all these complex transactions get cleared and priced.
Right, and this mechanism is all about synergy. It's about increasing the velocity of market activity across the entire system. When you introduce a simple, regulated event contract, it complements and is expected to spur activity in related financial products.
So you're talking about driving more overall trading in things like traditional futures, options, volatility products.
Hmm.
Because now there's a new, simple entry point for this kind of event-based speculation that feeds right into the existing ecosystem.
That is the core idea. Let's say you're a sophisticated hedge fund. You might use the Gemini prediction contract to get a quick, cheap view on the direction of a very specific event, maybe a short-term regulatory action.
Right.
Once you've established that probability, you can then go use traditional CME futures or options to hedge that small bet, or maybe structure a more complicated relative value position, or apply some serious leverage based on that initial probability you figured out in the prediction market.
So the new simple products becomes a kind of a high-speed, high-quality input for the existing high-volume derivatives world.
That's a great way to put it, yes.
And the first, and I guess most obvious player mentioned here, is CME Group, ticker CME.
Yeah, CME is the dominant force in so many traditional financial derivatives. They were a first mover in launching regulated Bitcoin futures and microfutures contracts. So while these Gemini contracts are event-based and binary, their emergence just validates the whole crypto derivative space.
And CME benefits not just from that general validation, but from what? Product migration.
That's a part of it, yeah. The new prediction market can broaden the user base. People who start with a simple yes-no contract might eventually graduate to the more complex, higher volume futures contracts that CME offers to manage their risk or express more leveraged views.
And CME's infrastructure, their clearing services in particular, are just foundational to the entire U.S. derivatives market. So more activity in regulated crypto derivatives in general just means more revenue from transaction and clearing fees for them.
Absolutely. They provide that necessary, trusted backbone that gives institutions confidence. Any expansion of the regulated derivatives universe just solidifies their position as the default place to go to manage complex risk.
Okay, and the second name listed here is Cboe Global Markets, ticker CBOE. Cboe is really known for options and volatility, right?
Yeah.
Especially the VIX index. So how does a new prediction market boost their business?
Cboe is in a similar position. They stand to gain because they manage exchanges, they provide crucial market data services, and they are leaders in listed options and volatility products. So if new regulated instruments like these prediction markets get widespread traction, Cboe's role in managing data flows and facilitating related products just sees more engagement, more transaction volume.
Let's talk about market data for a second.
Yeah, think about it. Any new regulated derivative that introduces event-based speculation needs real-time pricing data for analysis, for integration into trading models, for reconciliation. Cboe is a key provider of this kind of data, and they capitalize on every increase in data consumption and transactional velocity across the whole system.
And I'd imagine if these prediction markets generate volatility around specific events, like a regulatory ruling, that volatility has to have spillover effects into the existing options markets, which is Cboe's specialty. They're experts at packaging and trading event-driven volatility.
That's a critical point. Prediction markets put a spotlight on short-term event risk. Cboe can then offer complementary products, maybe new VIX-style indices that are tailored to the implied volatility that comes from those events. That gives sophisticated traders new hedging tools they can use right alongside the prediction markets.
All right, now we move to the third category of winners. This one focuses on data and analytics providers. So this is where we're monetizing the knowledge that comes from the market activity itself, moving beyond just transaction fees.
This is maybe the most innovative value stream that the material points to. Prediction markets generate a very specialized stream of quantifiable, real-time probability data. A stock price reflects the collective valuation of a company. But the price of a binary event contract, it reflects the collective likelihood of that specific future event happening.
Right. So if a contract that asks, will the FED cut rates in the third quarter, is trading at, say, 70 cents, that means the market is assigning a 70% probability to that rate cut. The price fluctuation itself is the market's consensus forecast, updating in real time.
Exactly. And this probability data is incredibly valuable. It represents the aggregate, real-time assessment of future events by all these market participants. Economic events, geopolitical, regulatory. This raw market-derived belief system can be organized, it can be packaged, and it can be sold as proprietary indices or as advanced forecasting tools in institutional analytics.
Asset managers all over the world are looking for any edge they can get in forecasting risk and outcomes.
And this data gives it to them. That consensus opinion, which is constantly being priced by professional and sophisticated speculators, it becomes a commodity that's almost more valuable than the transaction itself.
Because it's forward-looking, not backward-looking.
Precisely. Traditional forecasting models, they rely on backward-looking data or, surveys of economists. This prediction market data is forward-looking, and it's based on real capital being put at risk. S&P Global, ticker SPGI, is named here as a primary beneficiary.
Okay, SPGI. They have a huge footprint in creating global benchmarks and financial information. How would they even integrate this new kind of data?
Well, SPGI is a giant in index creation. They could easily integrate this new probability data into very specific, actionable index methodologies. For example, they could develop a regulatory risk index whose price is derived from the real-time contract pricing of all the binary events related to future SEC or CFTC actions.
So instead of just reading a news headline, an institutional client gets a real-time, market-vetted number that quantifies their risk conviction.
That's exactly it. They could also create metrics like market-implied conviction metrics for different economic outcomes, which would enhance the sophistication and the forecasting power of their existing products. It makes them indispensable to asset managers trying to navigate these complex, uncertain environments.
And the second firm mentioned is MSCI Inc., ticker MSCI. Their focus tends to be more on ESG and portfolio risk modeling.
MSCI is a world leader in providing portfolio construction tools, risk modeling, and governance analytics. They work with massive global institutional clients like pension funds, so incorporating this new real-time probability data could dramatically enhance their existing risk models.
How would a pension fund use probability data in its ESG or portfolio risk assessment? Can you give me an example?
Sure, let's say you have a sovereign wealth fund with major exposure to the renewable energy sector. They need to assess the risk of certain policy changes in multiple countries, MSCC. I could integrate prediction market data that reflects the market's implied probability of those specific legislative changes happening. This allows the fund to optimize its portfolio structure in real time based on these market-derived regulatory and geopolitical probabilities instead of just using historical volatility measures. It's a major upgrade to MSCI's value proposition for risk managers who need those granular, forward-looking insights that go beyond just standard deviation.
So across all three categories of winners, the mechanism is regulatory validation. That leads to more transaction volume, which spurs complementary derivatives activity, and then it enables this high-value monetization of the specialized probability data that the new products generate. It's a whole restructuring of value.
That really sums up the gaining side of the ledger. Now we have to pivot to the other side. The three categories that are expected to face some competitive pressures or headwinds because of this new regulated market structure.
Okay.
Category 4 targets the established world of online speculation, online sports betting platforms.
This feels like a very direct clash, a battle for the consumer's leisure and speculative wallet. Are we talking about a complete substitution, or is it more just general competition?
It's primarily substitution, and it's driven by regulatory framing and utility. The material makes it clear that there's direct competition for the speculative wallet, which is just that discretionary money that consumers set aside for high-risk entertainment. Regulated prediction markets offer an alternative outlet for that activity that's treated, regulated, and taxed as a financial product, not as gambling.
And that distinction, financial product versus gambling, that has to be key. It changes the perceived legitimacy, especially for users who might already be active on a brokerage app.
Correct. The material describes these markets as a clean trading-style way to bet on events. So if I, as a consumer, can place a short-term, event-driven wager on a political outcome or a sports championship or an asset price movement through a CFTC-regulated financial contract, that regulated structure has several competitive advantages over a state-licensed sportsbook.
What are those specific advantages for the user?
3 things really stand out. You have regulatory certainty, you have tax treatment, and you have liquidity. Gains from financial contracts can often be offset by losses in other investment products, which is not the case for gambling winnings. And second, the perception is that a regulated DCM offers greater price discovery and certainty in settlement than your typical sports book. It's competing for that user who's looking for high-velocity speculation, but prefers the structure of the financial market to the leisure structure of a bookie.
The first company we see listed here is DraftKings, ticker DKNG.
Yeah, DKNG's revenue is heavily reliant on user engagement, the frequency of wagers, and the margin they keep from those wagers. They now face a potential diversion of those speculative funds. If a meaningful segment of their users, the ones focused on rapid, event-driven speculation, who are often their most profitable segment, start allocating that discretionary risk capital to a financial market alternative.
DKNG sees that capital pool shrink.
Exactly. This could potentially reduce their overall gross gaming revenue and, dampen their growth expectations, especially in markets where both types of speculation are easily available.
So they have to find a way to keep their users engaged when there's a competitor offering what is functionally a similar product event speculation, but with a more formalized financial wrapper around it.
That's the challenge. And Flutter Entertainment, ticker FLUT, which operates the major brand FanDuel, they face the exact same competitive challenge in the U.S. market. Their user base has that same group of highly engaged speculators who are interested in short-term event outcomes. The rise of a CFTC-regulated competitor targeting that impulse to speculate is a direct headwind. It targets the higher frequency segment of their user base.
Okay, now let's transition to Category 5. This one looks at retail brokers reliant on speculative options flow. So this suggests a competition not with gambling, but within the existing regulated trading ecosystem itself, targeting things like weekly and zero-day options.
This focuses specifically on how short-term traders choose to act on their risk appetite. The introduction of these simple yes-no prediction contracts, it provides a surprisingly compelling alternative to complex, fast-paced speculative trading instruments, primarily options with very short expiration dates.
If trading a highly complex zero-day option is like flying a jet, where you need to know about dozens of inputs, volatility, premium decay, gamma risk, then this binary prediction contract is like ordering a taxi. Yes or no, I get to my destination. That simplicity has to be the core competitive mechanism.
It is. It's the simplicity of the user experience, and it's coupled with the speed of the outcome. The material suggests that some short-term retail traders will switch from complicated weekly and zero-day options to the inherent straightforwardness of these regulated prediction contracts. Both of them satisfy that need for high-velocity, speculative, event-based exposure, but the prediction contract. It just eliminates all the advanced quantitative knowledge you need to successfully trade short-term options. It's a pure directional bet, and that's very appealing to the retail segment that's driven by quick, defined outcomes.
Robinhood Markets, ticker HOOD, is identified as facing some pressure here. Now wait a second. Robinhood's whole brand is built on simplicity. So why would a simpler product be a threat to them?
It's because HOOD relies so heavily on transaction revenue from options trading. Specifically, payment for order flow from high-frequency options activity is a major part of their business model. Their simplicity is focused on the interface and access, but the underlying product, options, is still mathematically complex.
Ah, I see.
So if the simplest traders, the ones who generate a lot of that high-velocity options flow, move their capital to an even simpler prediction market structure, it directly impacts HOOD's overall transaction volume and the revenue they get from that high-margin options flow.
So a reduction in speculative options volume, even if it's a small percentage, it directly targets a primary high-margin revenue stream for their business model. The simpler product is a threat precisely because it caters to that need for speed and speculation, but without the required options complexity.
Precisely. And Charles Schwab, ticker SCHW, is the second name in this category. They're, of course, a much broader, more diversified brokerage.
Yeah, SCHW caters so much to long-term investors, retirement accounts.
Yeah.
How exposed are they really to a migration of short-term options traders?
It's true that SCHW has a broader client base and more diverse revenue streams, but you have to remember they also acquired TD Ameritrade, and that brought with it a vast and very active platform for derivatives trading, thinkorswim. They still generate substantial high-margin revenue from brokerage and options activity within that speculative segment.
Okay.
So they have to consider the potential reduction in that speculative options revenue if these short-term, high-volume traders shift their focus to these new, simpler event contracts for their quick directional bets. It's a competitive push that targets the profitable margin of their speculative trading flow. It might even force them to, reduce commissions or increase incentives just to keep that options volume on their platform.
Right, that brings us to our final category of headwinds, category 6. This one looks at Bitcoin leverage proxies and miners. And this is all about finding the most efficient and cost-effective way to get leveraged exposure to the underlying price of Bitcoin.
This is a textbook example of a substitution effect. It's based on utility and risk. Historically, a lot of these high beta mining stocks were used by investors as a kind of synthetic way to get leveraged exposure to Bitcoin's price. Because their operational costs, electricity, equipment are relatively fixed, while their revenue is tied to the volatile price of Bitcoin, their stock prices tend to amplify the movement of the cryptocurrency itself.
So before highly regulated, direct derivative instruments were widely available, or at least easily accessible in the US. If a trader wanted a risky, directional, and leveraged bet on Bitcoin's price, buying stocks like Marathon Digital or Riot platforms was one of the clearest ways to do that in the equity market.
That's absolutely correct. And the material states that if traders can now get access to direct regulated event exposure concerning specific Bitcoin price levels, the reliance on these high beta mining stocks as a way to get that synthetic leverage, it decreases dramatically.
It makes sense. Why would a speculator use a proxy that comes with all these operational risks, like unexpected electricity price spikes or hardware failure or changes in global hash rate, when they could just bet on the price directly and simply through a CFTC-regulated contract? The direct, clean path usually displaces the complicated proxy.
It does. Let's look at Marathon Digital, ticker MARA.
Okay, MARA.
MARA, as a major mining operation, often attracts a disproportionate amount of capital from speculative investors precisely because of its high correlation and volatility relative to Bitcoin. Now, the speculative portion of MARA's investor base, the people who hold the stock purely as a leveraged instrument, not as an operational investment, they might now find a cleaner, less operationally complex way to get that exposure through the prediction markets.
So if there's less need for this leverage proxy function,
MARA might see a decrease in speculative demand, and that could potentially impact the premium at which their equity trades compared to their peers or their own operational metrics.
the valuation of these companies becomes less about the immediate pure price movement of Bitcoin and more about their actual capacity and operational efficiency once that speculative capital finds a more direct place to go.
Exactly. And Riot Platforms, ticker RIOT, is facing the same competitive dynamic.
RIOT is in the identical position as MARA then.
Yes. They're discussed in the material in the same context of potentially lower investor demand if their main function as a highly volatile investment vehicle tied to the underlying asset is supplanted by these direct regulated prediction contracts. The easier and more formalized the direct exposure becomes, the less necessary the synthetic exposure through mining stocks is for short-term traders. It just simplifies the exposure mechanism for the trader and reduces the reliance on these equity vehicles for pure price speculation. The market, as the material suggests, is always moving toward efficiency.
So this regulatory action from the CFTC, it really functions as a powerful market catalyst. It's driving efficiency and is changing competitive dynamics across all these different previously distinct sectors. The winners are the ones who benefit from regulatory clarity and the ability to monetize these new data streams, while the losers are the ones whose existing products, whether they're in gambling or in complex derivatives, are undercut by the superior simplicity and regulatory backing of the new binary event contracts.
To synthesize all this, the trajectory that the material points to is a continued movement toward broader regulatory acceptance of crypto products, delivered through new, simple mechanisms for event-based speculation. This new class of regulated financial derivatives competes directly with established speculative outlets, whether that's online sports betting, which is a competition for the speculative dollar, or high-velocity options trading, which is a competition based on product simplicity. The introduction of simplicity and regulatory clarity targets the consumer's impulse to speculate and provides a new, highly efficient channel for that risk appetite.
We've seen the material point to competition in two very different spaces: gambling and high-frequency brokerage. So here's a final thought for you to consider as you process all this information. Which sector, the online sports betting platforms like DKNG and FLUT, or the retail brokerages that rely on options flow like HOOD and SCHW, which one do you think might face the greater long-term competitive pressure from the rise of these regulated event contracts? The answer probably comes down to which customer base values simplicity and regulatory certainty the most when they're placing their speculative bets. And before we close out this conversation, we have to state clearly that this discussion is based purely on the viewpoint of the material provided by the author. This is not financial guidance, and it does not constitute a recommendation to buy or sell any security.